Welcome to accounting class. Today we're going to chapter 4, depreciation of assets. What is depreciation? Depreciation is an operational expense of a business. It is charged in each accounting period so as to write off the cost of an asset over its useful economic life. A business must charge depreciation each year against its profit. Otherwise, before we go into that, there's depreciation because we need to measure the loss and value of a fixed asset over its economic life. That means as a business or as a firm, we use assets. So those assets that we use, they help us in the production of goods and services. So in the course of producing, we make profit from them, out of them. So the profit we make out of them, we need to charge depreciation from them, because if we do not, we will be overstating our profit. So with depreciation, we would know the economic useful life, the lifespan of the assets we are using in terms of operation. With depreciation, we'll be able to know the future value of our assets. So a business must charge depreciation each year against its profit. Otherwise, profit will be overstated. Without charging depreciation on your assets, you might be overstating your profit. And overstating your profit means you are misleading, you are giving a misleading information to the stakeholders. So the balance sheet will not show the true value of fixed assets. Without depreciation, you won't be able to know the real value of the equipment or machines that you have as a business. So what are the causes of depreciation? Number one, natural usage, wear and tear. They are equipment, they are machines. In the course of using them, they cannot remain the same. They can't have the same capability. They can't continue to be the same when you start using them. When you buy a new equipment or machine, in the course of using it, it starts losing its value in terms of wear and tear. So it will start showing reasons for maintenance. And as soon as it starts showing reasons for maintaining or for maintenance, it means it has started losing its value. So that is wear and tear. This is caused as a result of usage. So kilometers added to a vehicle as it delivers the firm's goods. So because the vehicle starts moving, as soon as the vehicle starts moving, it starts wearing and tearing. That's one of the reasons why we have depreciation, or the causes of depreciation. The second one is obsolescence. It is obsolescence because it's becoming outdated. Every now and then, there are always inventions, there are always new products, there are always new equipment, there's always advancement in technology. And because there's advancement in technology, there's always going to be a new product. So the new product will outshine the old product. So whatever we use right now, in the next 3 years, there's going to be a new model of it, and that means we need to change. So that is obsolescence, which is out of date or becoming outdated. Like the iPhone 11 replaced by the iPhone 12. iPhone 11 is outdated, then there's iPhone 12. Afterwards, there's going to be iPhone 13, 14, and so on. So each time that passes by, a new product will be out, a new product will be produced, and the old one becomes outdated. And that's another reason for depreciation. The third one, end of its useful economic life. That means the end of the lifespan of such products. So the product can no longer serve the cost of the operation. So it means it has to be dished out. So that's extraction from your mine or well. But as soon as the extraction will start, if you are extracting, there's a day that the extraction will stop, when there's no more natural resources in the well, or there's no more natural resources. And the last one is passage of time, lease of a property. Time will lapse, or you have 10 years. As soon as the 10 years lapse, it is done. So that is what passage of time is about. So the next slide. Factors to consider when estimating the amount of depreciation to be charged. So what are those things we put into consideration when we want to charge depreciation, or what we want to calculate, when we are about to calculate depreciation? The first one, the cost of assets. We're talking about the historic cost of that asset. It is important to know the cost of that asset. So for example, 10% of cost per annum as the cost of asset vary. The higher the cost, the higher the depreciation charge. So we need to know the cost of an asset, because as soon as we know the cost of an asset, we will be able to know the amount of depreciation we need to charge. The higher the cost of an asset, the higher the depreciation charge. Two, estimated economic life. We need to know the expected lifespan of that asset. Is it 10 years? Is it 5 years? Is it 15 years? So we need to know the expected lifespan of that asset before we charge depreciation. The third one, the scrap value, which is the residual value. The guaranteed market value, which is what the price of that asset will be in the course of selling it. We need to know an estimated value for that, which is called the GMV. And the next one is the method of depreciation. As soon as we discover or we figure out that we need to charge depreciation, it is important to find a method to use in terms of depreciation. We have the straight line method, we have the reducing balancing method. And as soon as the business chooses a method based on accounting concepts, a business must continuously use the same method year in, year out. So if a business is using straight line method, it must continue to use straight line method year in, year out. And the last thing to put into consideration is the type of assets. The type of assets in terms of, there are some assets they depreciate at a faster pace, and there are some assets that depreciate at a slower pace. For example, buildings do not depreciate at a faster pace, but equipment like cars, vehicles, they depreciate on a faster pace. So this is also what you have to put into consideration when you are measuring or when you want to calculate depreciation. So this method of depreciation is most appropriate when an asset loses most of its value in the years immediately following purchase. So we have different methods of depreciation. We have the straight line method and reducing balancing method. So in the next class, we're going to go into talking about the kind of the methods of depreciation, which is the reducing balancing method and the straight line method. Thank you.